Have you ever wondered what makes an economy suddenly collapse, sending markets into a tailspin? Financial crises can knock the economy off track. People panic, asset values plunge, and recessions follow. They often hit fast and leave lasting scars. For example, during the Great Depression, U.S. unemployment shot from 3 million to 12.5 million in a few years, roughly a quarter of the workforce. In a crisis, fear spreads everywhere. Investors panic, depositors pull their money out, markets crash, and lending grinds to a halt. So what causes these sudden meltdowns? Let's break it down step by step. It often starts with lots of borrowing. When the economy is riding high, people get more comfortable taking risks. Banks loosen lending rules, and borrowers breathe easy. Experts note that during calm times, people get a bit overconfident and start taking ever bigger bets. In simple terms, success breeds overconfidence. Imagine a boom where home prices soar. Lenders see prices rising and start handing out mortgages to nearly anyone. By the mid-2000s in the US, roughly 1 in 7 mortgages was a risky subprime loan. That means tons of money was tied up in debt that might never be repaid. Meanwhile, total household mortgage debt swelled. In fact, U.S. mortgage debt went from about 61% of the economy to 97% in just a decade. Yes, nearly as much debt as the country was producing in a year. What happens if something goes wrong in that setting? A little hiccup, say, a rise in interest rates or a job loss can trigger a wave of defaults. Borrowers suddenly can't make payments, and lenders start losing money. As losses mount, banks and investors get nervous and stop lending. This debt-heavy stage sets a dangerous scene. But debt alone isn't the whole story. It usually teams up with another dynamic, asset bubbles. When everyone thinks prices will keep rising forever, a bubble forms. Asset bubbles mean prices, for homes, stocks, etc., inflate way beyond what fundamentals justify, driven by pure enthusiasm. During the 2000s US housing boom, average home prices in the United States literally doubled between 1998 and 2006, the fastest jump on record. Everyone assumed houses were a guaranteed investment. Bubbles thrive on optimism. As one guide explains, they happen when assets become overvalued by collective excitement until confidence finally runs out. When a bubble bursts, those inflated prices crash. After 2006, U.S. home prices fell by over 20% on average as the bubble popped. The bursting of a bubble can spread havoc. Investors who were counting on rising prices get wiped out. Financial products tied to those assets, like mortgage-backed securities, plummet. Banks holding those assets face huge losses. In 2008, once home prices started falling, mortgage defaults spiked, and mortgage-backed bonds became almost worthless. Suddenly, the precarious debt levels were exposed. Panic hit the markets. Banks became unwilling to lend to each other, and credit markets froze. So far we have easy borrowing, plus a giant bubble, plus a spark like falling prices. The result is a crash that shocks banks and investors. Let's look at what happens to the banking system next. Banks are the gears of the economy. When they seize up, the whole system stumbles. A classic problem is the bank run. If depositors lose confidence in a bank, they rush to pull out their money all at once. This panic can turn a healthy bank into an insolvent one overnight. History shows how scary this is. In the early 1930s, after the 1929 stock crash, Americans lined up outside banks. Many banks had lent too aggressively and suddenly couldn't cover all the withdrawals. Waves of bank runs swept the country. It got so bad that in 1933, the commercial banking system collapsed. People lost their savings overnight, and credit simply dried up. Fast forward to 2008. When the housing bubble burst, even major banks and investment firms started sinking. Lehman Brothers went bankrupt, and insurers like AIG needed emergency bailouts. When these financial giants faltered, panic spread. Banks stopped lending to each other. Consumers found mortgages and loans drying up. In short, without trust in the banks, the economy grinds to a halt. Once confidence disappears, everything gets worse. Bank failures lead to business bankruptcies, unemployment rises, and the crisis feeds on itself. There's another piece of the puzzle: government policies and regulations. Sometimes what authorities do, or fail to do, can make a crisis worse. For example, look at the late 1920s. US regulators saw stock speculation on the rise and decided to tighten policy by raising interest rates. The goal was to cool off the market, but this move slowed the entire economy and helped trigger recessions worldwide. A step meant to prevent a crash actually contributed to one. In more recent times, consider banking rules. In 1999, the US repealed parts of the Glass-Steagall Act, allowing commercial banks to merge with investment banks. The idea was to modernize finance, but it also let banks grow into giant conglomerates. This made a few institutions too big to fail. When those megabanks got into trouble, the government felt it had no choice but to bail them out. That safety net actually encouraged risk because bankers knew they'd be rescued. Sometimes it's fiscal policy, not banking policy. In the 2010s, for instance, Greece had borrowed so much that its debt became unsustainable. When its economy hit a rough patch, Greece almost defaulted. The crisis forced massive bailouts and austerity. This showed that reckless government borrowing can also trigger a financial crisis, even spreading fear to other countries. In short, poor regulation, overly loose rules, or abrupt policy swings can all light the fuse on a financial crisis. We live in a connected world. Trouble in one corner can quickly become trouble everywhere. Take the 1997 Asian financial crisis. It started in Thailand with a debt-fueled property boom. When investors sensed trouble, they pulled out of Thailand and then other Asian markets. Currencies collapsed across the region. What happened in Asia then shook markets worldwide, a true contagion. Experts even call it a textbook example of a financial crisis spreading globally. Shock events can also trigger crises. Oil price spikes, wars, or even pandemics can suddenly derail an economy. Think of 2020. The COVID-19 pandemic froze global business. Supply chains broke and companies couldn't pay debts. Stock markets initially crashed and governments rushed in with support. While this crisis wasn't caused by borrowing or bubbles, it showed how a sudden shock can ignite financial collapse when the system is vulnerable. The takeaway is that in our global economy, we're all connected. When confidence falls in one place, it ripples everywhere. So what causes a financial crisis? It's usually a mix of too much debt, overheated prices, fragile banks, and policy mistakes, often sparked by panic or an unexpected shock. When those ingredients combine, the effects can be devastating. For example, during the Great Recession, 2007 to 2008, the US economy shrank by 4.3% and unemployment doubled to 10%, the worst downturn since World War II. Millions of people lost jobs and homes. But the key is to learn from history. Now you know the red flags: piling debt, runaway asset prices, and wavering bank confidence. If we recognize these patterns early, maybe we can stop the next crash before it takes hold. Stay curious and stay aware. A little knowledge goes a long way. Thanks for watching.